Welcome everyone, another episode of Financial 15. Kevin and I are back with some fantastic information. Today we're talking about defined benefit pensions compared to defined contribution pensions. What's the difference? Is there one better than the other? How could it impact your retirement plan? We're going to tackle all of that. You want to stick around.
Yeah, today a topic that a lot of people don't really know what the differences are in the pension plans. We want to get through to that. And again, if you want to know more information about this or any of the other scenarios that we've been talking about in the financial world, please visit us at beckerorr.com or go to our YouTube channel where you'll get all our videos on there, or like us on Facebook. We're more than happy to deal with all of these situations going forward. So Clint, defined benefit, defined contribution. What are we talking about? They're both pension plans, but there are differences, isn't there?
There are some pretty big differences. So we have to define what each of them are so we can understand the ins and the outs. We'll start with a defined benefit plan. And the key here is in the title, defined benefit. That's what they're guaranteeing. They're guaranteeing the benefit. So you're going to have an income. So you work for a company, you contribute, the company contributes. And when you retire, there's going to be a guaranteed income for the rest of your life. So they're defining that benefit. You get that guaranteed income stream. Now, you're not picking the investments. You put the money in the pot, and then it's the company's responsibility. They're going to have a team of experts. It's their responsibility to handle the investments. It's not your decision. And then how do you determine that benefit? Well, there's a preset formula. Each pension can be a little different, but quite frequently, they're going to look at your age. They're going to look at your salary, the number of years of service. Those are typically the big factors that go into determining what the benefit is that you'll receive. So again, defined benefit plan, we'll go through a few more details here, but think about that middle term benefit. That's what's being guaranteed. It's the income when you retire. You can see some of the factors there. What are some of the other points you want to touch on for a DB plan here, Kevin?
Yeah, basically it's the known. And that's what we say. Have an idea of how much your pension will be. You know what it is. So going in, depending on what the formula is, you know what you're going to get each and every year after that. And again, some of these things, they're indexed to inflation to help protect. So if it was a $50,000 a year pension plan, 2% a year is inflation, it will go up every year by that 2%. So again, it's a known amount that you're going to be able to get. That's a big factor for a lot of people, knowing what your pension plan is going to be. Again, your spouse might be able to get some survivor benefits. A lot of these plans will include a certain percentage that can go there, or an amount that you can go over for a certain number of time periods. So for 10 years or 15 years is a guarantee. The pension in this case, again, is another reason. The pension takes the most of the risk. And what that means is the employer. We know how much you contribute in there. We don't know how much the employer is going to contribute, but we do know what the end amount is. And that's a big factor. So all this risk is being taken by the company that has the plan to begin with. And finally, payments can be considered pension income after the age of 55. You don't have to wait till that traditional 65. If you're paid up in your pension or you take it early, you can start collecting it at 55. That's a big factor when it comes to income splitting down the road. Now, that sort of gives a lot of definition as to what defined benefit is. What are we talking about when we talk about defined contribution, Clint?
Yeah, the other side of the coin. And again, defined benefit, the key word there. They're guaranteeing that income stream in retirement. You work for a number of years and you get a guaranteed pension, say $2,000, $3,000 a month, whatever the formula equates. Defined contribution, again, focusing on that middle word, the contribution. What the company is defining, what they're guaranteeing is saying, we'll put some money aside for your pension. They're not going to guarantee an outcome. They're just saying they're going to be putting money aside for your eventual retirement. So there's no guarantee. There's going to be a pool of cash. You might outlive that cash. That's really up to you. So both you and the company here are putting money into the pot. You make the investment decisions. Quite often how these plans work is you're going to get a big provider. Normally the life insurance companies are dominant in this market. So a Sun Life, a Canada Life, one of the life insurance companies, and you'll get a handful of mutual funds and they'll say, pick amongst these funds. And then you determine the investments for that pool of cash. So as opposed to the defined benefit plan where it's all hands off and the company's doing the work, here you're the one picking the investments. And then the value of the pension really depends. There's no guarantee on the outcome. They're saying we're putting some money aside. You pick the investments. We'll see what happens. There'll be a pool of cash there at retirement. How big that pool will really depend on the contributions and the investment return. So they're focusing on how much they're going to put aside, how much they're going to contribute, and the final outcome will be a result of the investment returns. A few more points here, Kevin, on that DC plan.
Yeah, exactly. And I mean, I guess the biggest definition that we can look at between the two of these things is for a defined benefit plan, we know what you're going to get at the end of the time frame. Yeah. Whereas the defined contribution, it is unknown. And the main reason is because you're contributing as well as the employer. So again, there is no guaranteed protection in this plan against inflation. We can't, because you're making the investment decision choices. So whether you're going to get more or less may depend on what you're putting it into. A flexible estate planning option is another thing that we have to look at. This money is yours. You've put it in. It's either been matched by somebody or there's been a contribution from the employer going in. So these funds can be left to the estate, as opposed to most defined benefit plans where if you haven't got any guarantee, once you die, that's it. It's gone. So this can go over. And here you are taking the risk as opposed to the employer. And the reason is because you're making a lot of these investment decisions. So if you've chosen right, you're going to do very well. If you've chosen wrong, it may not be as much as you want. And again, another big factor is these payments are not considered pension till after 65, as opposed to the benefit scenario, which can be taken early at 55. You could take money out of the defined contribution at any time you want, really, but you can't consider it pension income until after the age of 65. So very much a lot of differences between the two, even though they're defined as pension plans. So what other points do we want to know about what's going on with these?
Yeah, to reiterate a couple of factors there. One, the flexible estate planning options. You might be thinking defined benefit sounds a lot better, and you're probably right. There's a lot of positives as an employee, and defined contribution that it's probably not as good. But one of the positives of defined contribution is you have more flexibility in the estate planning department. It's a pool of cash. What happens with that pool of cash is really up to you. The defined benefit plan, you get an income stream. You get a paycheck every month until you die, and then your spouse can get a smaller paycheck for a while, and then that's it. There's nothing left for the kids or the next generation. Not the case here. It's a pool of cash. You have more options. And that last point you hit on, Kevin, about pension income after 65, that's key for income splitting. One of the big ways people save tax in retirement is through income splitting. Now, the defined benefit plan, it'll qualify as pension income, which means it can be split at 55, defined contribution, an extra 10 years. So you do have a disadvantage there. Some examples, they might not call it a defined contribution plan. They might call it a group RSP. Maybe it's employee share purchase plan. There's lots of ways they can slice this pie, but they all fall roughly under that umbrella of a defined contribution plan. So we've sketched out the two big ones there, defined benefit, Kevin, defined contribution. I'll throw you the question here. What type of pension are folks likely to encounter, DB or DC?
Well, over the years, we've seen a substantial switch. When pension plans basically came out, most of them were of that defined benefit plan where you knew what you were getting at the end of the day. But recently, as we've seen in USA Today, there was a survey from the Department of Labor Employee Benefits Security Administration, and between 1986 and 2016, 73% drop in defined benefit plans in the US. Canada hasn't been that much different either. I mean, in the public sector, we've only had a 4% drop in the last 4 years. But in the private sector, you've gone from 22% to 9% in that same time frame. And so, as you can tell, everybody that wants to have a pension plan, defined contribution is the way they're going nowadays. And again, a lot of this has to do with cost certainty. When that defined benefit plan is there, we know how much the employee contributes, but the company is on the hook for everything else. And in low rate environment, that may be hard to be able to supply everything that's needed for that actual defined benefit. In the defined contribution side, we know what you put in, we know what the employer puts in. A lot easier for them to deal with. And a lot of the times the administration to run those plans is a lot simpler than what a defined benefit plan is. So cost savings come as well. So that's some of the aspects as to what we're likely to see.
Yeah, so DC is by far the more popular option. You gave us the stats there. So unless you work for a government or connected to a government entity, at this point, that's really the only DB plan offers. Everyone else in the private sector is pretty much a defined contribution at this point. But regardless, defined benefit, defined contribution, the key point here is you have to incorporate this into your personal plan, into your retirement plan. So tackle both. How do you incorporate it into your plan? Well, for defined benefit plan, you have to understand the formula. That would be my suggestion, because each defined benefit is going to have a slightly different formula. You want to have to understand, maybe not the nitty gritty, but just high level. If I work an extra 5 years, is my planning going to go up in value, down in value? How does that work? And then get your estimates. Normally once a year, they'll give you an estimate saying if you worked until 55, 60, you'll get this amount of income in retirement. So that'll allow you to do some planning if you understand the basics, the formula, and you have that estimate. What should people be looking for that defined contribution plan, Kevin?
Well, basically, it's as it says below, it's the company match. If they are going to sit there and you're going to put in 10,000, they're going to match you for 10,000. Take advantage of that. Max it out because it's free money going in there. It's something that's not going to go. I mean, it's basically doubling your money right off the hop as opposed to worrying about what the investment dollars do. So find out what that max is from your company and try to max out that match. You don't have to do more if you don't want, or if you can, that's great. And there's usually a percentage that they'll give you. It could be 5, 6, or 7% of your income, and then they'll match on a certain percentage of that. But do make sure you know what that is and max out the match the best way you can, because that's going to give you the most money at the end of the time frame when you want to look at retirement.
Most bang for your buck right there. You're thinking, where should I put my money? TFSA, RSP. Well, if you have some room in your company plan and they're going to match it, that's an automatic double of your money. That's probably the best bet. Once that's topped up, then you can look at the other options.
Exactly. All these things need to be going. And as you mentioned beforehand, this is basically a difference between private sector and public sector nowadays. And the defined benefit, as we see, is starting to go down. And just an interesting side note, Nova Scotia is the only province in Canada that actually eliminated the DB in favor of the DC. Will we see that across the rest of the provinces? Who knows?
But maybe other governments will follow suit. Maybe other governments will look at Nova Scotia. Hey, that's a cost savings. We're going to do the same thing. We'll have to see. But if you have more questions, you can get a hold of us. It's on the bottom of the screen there, chatwithclintonandkevin.com. We love hearing from you, whether it's a topic, something you want us to tackle, or a question about your particular situation. Happy to help out. Reach us, chatwithclintonandkevin.com. Any final words for the folks, Kevin?
Nope, I'm done.
Covered it all.
Other than that, that's perfect.
All right, well, take care. Stay safe. We'll see you again soon.